Thank you for joining us today for this Australian Equities Fund webinar. Pengana is a diversified funds management business. We have 12 independent investment strategies across a variety of asset classes, spanning domestic and global equities and alternatives, including private equity and credit. We partner with specialist teams around the world to bring fresh perspectives and differentiated investment products to your portfolios. In this update, portfolio managers Rhett Kessler and Mark Christensen will discuss the market, reporting season highlights, and portfolio positioning. Later in the webinar, we will be joined by Head of Distribution, Adam Myers, who will facilitate the Q&A. I'd encourage you to ask any questions that you may have, and you can do so by entering them into the question box at the bottom of your screen, and we will endeavour to get through as many as possible. I will now hand you over to Rhett and Mark. Thank you.
Good morning, everybody. Thanks very much for joining us for today's webinar. Rhett and I will just take you through a number of slides. A couple, if you've been with us or seen us before, you'll probably recognise some of them. So we won't dwell on old material, but Rhett will then follow through as well, give an update on how we're thinking in the current environment, and then we might discuss a few stocks at the end as well. So we start off with just the team, I guess, the idea being that the team is quite settled. David Glasser, our most recent addition to the team, has now been almost 3 years with us and is going very well, and we're very pleased to have Stephanie join us again from maternity leave. Stephanie holds our team together, and I think the whole Pengana firm together as well, so it's wonderful to have the team back together and working well. There's been a lot of things changing in markets over the last couple of years. It has been challenging times. We always talk about it's always interesting times. What remains interesting is just the thing that changes. But our overall philosophy as to what investors' needs are remains the same, and we continue to prioritise and focus on capital preservation as being the number one goal, and then delivering a reasonable return to our investors. And we define a reasonable return as being the risk-free rate, so what you could get for putting your money in the bank, but plus then a risk premium for taking on the extra risk of investing in equities, which we determined to be about 6%. So by that formula at the moment, we think a reasonable return is about 10% for investors in the current market environment. It didn't seem like that long ago where the risk-free rate was zero, and by this definition, that could have been a 6% definition of reasonable return. And I just suggest that that's not really how we've thought about it. We've always considered the 8 to 10% range being, where we aim to deliver. And I guess with interest rates having risen to where they are now, we are back into that range. So overall, we really are focused on preserving and growing the purchasing power of the funds that are entrusted to us. Our strategy, which we have stuck to since day one, we put this chart up to sort of show how has it worked out since inception, and we're pleased that the chart has shown the strategy has worked for our investors. The green line is that benchmark that I just referred to, being cash plus 6% over that time. You can see the green line accelerating recently as interest rates have picked up, and we're pleased that I guess it has been a good outcome for investors over that time. It has been a better outcome than simply investing in the market itself, which is the sort of the grey line a little bit below. Of course, the strategy hasn't worked perfectly in every single moment of that time since inception, and that's the nature of investing in equities. But really, this slide does give us confidence that the strategy is right, and so we stick to it. Calendar year 2022 was a difficult year for the market and particularly for the fund, and we've discussed in various forums what happened during that year and various measures that we've taken. I guess what we'd like to sort of say now, where are we at now that we're 9 months into calendar 23? We've got a lot of confidence out of the fact that the fund is actually been behaving a lot more like we expect it to over this calendar year. It's nice over a short time frame to be able to say we're outperforming the market, which is the case for the 9 months, but that's only a very short time period. More importantly, it is the fact, as I said, the behaviour of the fund over this calendar year to date, and that is to say we've participated in months that have been strong, and the fund has proved more resilient in months that have been a bit weaker. And it's that behavior which gives us confidence that once again the strategy and the fund. And I think part of the reason for that we'll talk about is maybe the market environment might be coming back to more style that suits our style. But once again, we feel that it's well positioned and behaving well this calendar year to date. I'll hand over to Rhett now to take you through the next couple of slides.
Thanks for that introduction and the first part of the presentation, Mark. So I really wanted to talk about this slide. I know many of you have seen it before. For a long time, we feel like we've been speaking about this basic foundation to investing without really the penny dropping. I think certainly in the last quarter, the penny has really dropped, that the cost of money sets the pricing of any long duration asset, whether it's equities, property, long bonds, etc. And the other thing I really wanted to point out is if you have a look at this chart, almost to the day when I came to the country, we've had 27, 28 years now, ever declining interest rates, followed by a very quick reset. And this tailwind of ever declining interest rates has really worked its magic to improve the valuations of long duration assets. And so this tailwind, unfortunately, is now over. And in spite of it educating a whole generation of investors that time in the market gets rewarded by valuations just going up and up, we think this is a very different environment. And so we think that our methodology, our investment methodology about focusing on getting paid a decent after-tax cash earnings yield while the company itself grows, rather than just relying on ever compressing capitalization rates, is the way to invest. We do note that there's been a sharp rebase at the bottom, and it does appear that the gravity of a higher cost of money continues to affect all kinds of things, particularly valuations of long duration assets. Bear in mind that we're barely back to long-term averages. People who say that interest rates are really high, no. And our outlook is that we're not seeing any quick relief. So how do we apply this to our equity strategy? Mark, if you go to the next slide, please. So our high-level view, and I'm going to get into into the weeds in a sec, but our high-level view is that inflation continues to percolate through the global economy, and we think its impact will be enduring. Bear in mind that there's lots of debate about inflation coming down. We hope it does come down, and we think it might come off from these elevated levels. But bear in mind that when you talk about inflation coming down from 6 or 7 down to 5 or 4, maybe even 3, but that's very unlikely, it's an increase of only 3 on an existing base of anything between 5 and 8, depending on which country you're in. And so the cost of virtually everything has gone up. We know that's been caused by a combination of stimulus-induced demand, as well as very widespread supply chain constraints. We think the next level of inflation will be caused by monetary issues within central banks. Think about those trillions of dollars that were acquired of very long duration bonds by the central banks, part of their quantitative easing, placed on the taxpayer's balance sheet, and those are going, the losses now have to be borne by taxpayers, and the only way to pay those back is to print money. Secondly, think of the very large debt or deficits within global economies that used to be funded at rates close to 1%, particularly in the States, and now being funded at rates closer to 5%. That's a 5-fold increase in the cost of money to the government. That can only be funded by printing money. And so I know it's not a rosy picture I'm painting, but I do think that very optimistic views on inflation coming down and therefore massive interest rate cuts we think is unlikely. More importantly, inflation is continuing to impact on the corporate cost base. I'm going to talk about that in a little bit more later on, and also from a higher level looking down, the consumer's been remarkably resilient to date, but pressure continues to mount. And we can explain why we think the consumer's been remarkably resilient. Mark will talk about that in a sec. But in virtually every category, cost of everything, cost of living has gone up. Thanks, Mark. If you go to the next chart. So what does this mean for equities? And you know, we're all accountants and we think about these things in a very granular level. And that's been the foundation of our research. So I'm going to start on revenue, then I'm going to go to costs, and then I'm going to go to interest costs. So starting off with revenue, for us, revenue is really just volume times price times the mix. And we think that general price increases have started to percolate through, but they're very unlikely to offset volume weakness. This is for companies supplying goods to their customers. And we think the mix will also be negative. And so our default for most companies is that revenue forecast should be flat at best, at least for the next couple of years. Now, that's not for everybody. And so our preference would be for companies with pricing power. And that means that they can successfully pass through the higher cost of doing business to their customers, combined with resilient demand or inelastic demand, and where companies can eke out market share gains. So if I had to give you some examples, it would be Telstra. It has real pricing power. It's putting up its prices for telcos at CPI. So mobile phone plans are going up at CPI. It's very resilient demand. If you try to take away a mobile phone from any of your teenagers or even yourself, it's something we can't do without. And Telstra continues to gain market share. So we can step down to the next line on the costs, and we think inflation continues to percolate through all cost of doing business lines. And the main culprits are wage growth, rents, energy, insurance, etc. And so our default expectation for costs for most businesses is up 4 to 5%, implying a very negative operating leverage. If your top line stays flat and your cost line's going up, we think that means negative cost leverage. Now, the preference for us, again, is companies that can eke out meaningful productivity enhancements or have tight control over their cost basis, whether it's fixed or they have the power in the relationships with their stakeholders. And again, if you use the Telstra example, they are taking out a lot of costs. They still have a large amount of their costs being labor, but they are reducing their labor force. And remember that a lot of their in situ cost base is a sunk cost. So the network is really CapEx that has been spent over decades, which means they have a very favorable positive operating leverage. The one that really stands out for us in the last reporting season was the fact that most analysts got the EBIT or EBITDA numbers right for the companies they predicted. But for some reason, they managed to get the debt costs totally wrong, in spite of it being quite formulaic. So you knew what your debt levels were, you knew what your cost of debt had changed, up by 400 basis points. And so we saw most companies have sharply higher cost of debt. And so you can imagine if you've got a flat top line, you've got costs going up, and then you've got interest costs going up. That's what we call negative financial leverage. And so our preference in companies here would be for those companies which have net cash balance sheets, or at least long-term fixed cost debt. And so here the companies that come to mind would be JB Hi-Fi, a Super Retail, which have net positive cash on their balance sheet, the health insurers. And then if you think about fixed long-term debt, it would be companies like Telstra again, or a CSL. Mark, I think I'm going to pass it back to you now.
Thanks, Rhett. So we've just got a few slides here with a few charts. that lie behind some of the trends referred to, and in particular, the one that seems to have most investors puzzled is how is the consumer remaining so resilient as it is? We've probably for the best part of 18 months now, the market has been anticipating this consumer cliff to present itself in an almighty bang via company earning seasons where you get the profits and the results of consumer exposed companies all of a sudden collapse. And every time that doesn't happen, that can seems to get kicked a bit further down the road, as in, well, it hasn't happened yet, it'll happen in the next 6 months. And I think what we've seen in the last 6 months is maybe a realization, or the broader thinking around that topic is migrating away from a consumer cliff scenario to a soft landing scenario. So I think there's no denial that there is still pressure in the channel and in households across the country, but more evidence is suggesting more that soft landing. And so just to touch on a couple of things, the single biggest factor in our view has been the employment data, and specifically the employment rate. So everybody still has a job in the country if we're talking at a macro level. The employment figures are what is considered virtually full levels. And I think just as importantly, or possibly more importantly, is there doesn't seem to be a situation where people are concerned about losing their jobs at the moment. And again, I'm talking at the aggregate level. Obviously, there are parts of the economy where that are stronger than others. But it is that concern about losing your job, even if you've still got one, which is probably the trigger for people to shut down on spending. But so far, it's held up very well. And these charts just show that essentially, despite the fact that there is a lot of cost pressures coming through the system, the wage growth and household income growth has actually also remained quite resilient. And it talks to a number of the factors. So on the left-hand side, you can see the color components of the chart. And you can see back in the COVID period where the factors that contributed negatively towards wages in Australia were the hours per person, which is the navy chart. And that's essentially the fact that shops closed and businesses closed, and so people were working less. And growth in employment, meaning there was actually job losses through that period as well. But if you sort of transform to where we are today, you've got quite healthy contributions from all of those drivers. So growth in employment, the aqua bars at the bottom, is a combination of people who didn't have a job previously getting into the workforce, but immigration is also increasing the overall workforce, which means that the total wages being earned in Australia in aggregate is also growing, and we'll talk about that in a moment too. The blue bars is the hours per person, and it's perhaps not surprising to see as household income pressures or cost pressures have risen, households are working more hours per person in order to make ends meet, and so that is increasing. The capability to do that and increase your income is another factor offsetting the pressures. And then the hourly rate, the red bars as well, and we are seeing wage inflation has been a feature of the last 12 months, but to Rhett's point, it does lag, and virtually every company we speak to in reporting season is telling us that wage growth is still yet to find its way through the system and will continue. So the left-hand slide essentially says, look, despite the fact there are a lot of cost pressures, wages are actually growing in aggregate in Australia as well. I won't go through all the components of the chart on the right in the interest of time, other than to say it essentially shows that the big factors that impacted household income negatively, you can see on the underside of the chart here, interest payments being that red bar. And I guess that's, certainly people who are on a direct variable exposure to their mortgages, but also as various households fixed mortgages rolls to variable. And you can see that having that negative impact. And I guess the sort of the grey bars is the income tax paid, which represents, I guess, bracket creep. Higher wages takes you up into higher tax brackets, and so that's more outgoing from households. But what that chart does show you, though, is that the sort of the peak of those negative forces is beginning to roll off as we approach the end of this calendar year. They've not gone away completely, but we're probably through the worst of it. And what remains is still wage growth and other income sources, such that the line, which represents the aggregate disposable income of households, is not too far away from seeing tailwinds once again. So the overarching message being that despite household cost pressures, there is some employment and income offsets that is at play, and which is helping the consumer stay quite resilient. The next slide is a slide that we found interesting out of the CBH full-year results this year, and it's these charts on the three sort of yellowy orangey charts on the left. And effectively the message is just to say, keep in mind that as interest rates rise, it does actually impact the different age cohorts quite differently. So the first chart on the left there highlights firstly the yellow bars on the left-hand side is the distribution nationally of where all the home loans, outstanding home loans lie. And it's perhaps not a surprise to see that most of the home loans, outstanding home loans, are sitting in that 25 to 34 and the 35 to 44 range. And so they're the cohorts which is experiencing, I guess, a larger impact from rising rates. In terms of the deposit balances, so cash in the bank is on the right-hand side. And again, perhaps not surprisingly, as we talk about it now, to see that it's the older categories that have all the money in the bank. And this does have quite a big impact on obviously how a rising interest rate environment is felt. You can see in the middle chart there, how is it manifesting itself in Commonwealth Bank's views? Well, they're seeing those younger cohorts savings diminish somewhat, in particular the 18 to 24. But savings rates are actually growing for each of the cohorts from 35 to 65 plus. So these are people that have reasonable, I guess, incomes and wage levels, but also savings balances that can enjoy the higher rate environment as well. And that manifests itself in what CBA are seeing in terms of the change in spending. So it really is just those younger age cohorts which are experiencing or actually spending less in CBA's observations. But because of the different profile and dynamics of all of the sort of the 35 to 65 category, they're actually noticing still growth in spending. So these are people that have less mortgage exposure and a greater savings exposure. And I think that's the other element that we can maybe underestimate, that it's not everybody in the country that is being negatively impacted by these rates, or at least the impact is a bit uneven. So we take that into consideration as well when we consider the overall resilience of the Australian consumer. One of the interesting dynamics which have been at play has been the opening up of our borders again to immigrants. And net immigration into Australia has been a feature, and I'll touch on that on the next slide as well for a little while. But during COVID, we understand on the left-hand chart shows us, or both charts show us, that immigration all but closed, and for reasons that we're all well aware of. But the doors have well and truly swung wide open again since COVID, and you can see both charts show you the very large step up in immigration back into Australia, and that has quite a meaningful impact across a number of sectors, perhaps making challenging housing dynamics. And that is an issue that is yet to be solved. But on the flip side of that, we've got more workers coming into the economy, generating more productivity, paying more taxes, consuming more goods, etc. So it really is a positive injection into the economy. And as we sort of consider that as a point of time, that's what's happening now. We also do another presentation in other forums about how we think we're living in a lucky country, in Australia, the lucky country. And this thematic really plays through there as well, that the overall population growth is a real differentiator for Australia's GDP outlook, or history and outlook, as you can see in this slide. So Australia's population growth is really amongst, if not the top, amongst the leading nations of the world that you can see in that chart just there, certainly in the last 20 years, but forecast for the next 20 years as well. And immigration is a big driver of that population growth. So not only, as I said, does it bring more workers into the economy from a productivity point of view, paying taxes and consuming, it has an impact also in terms of the median age of the economy. And the right-hand chart shows that Australia is very favorably positioned compared to a lot of economies around the world, given that the immigration comes in and helps to maintain a lower median age. And so effectively more workers and contributors to our economy, which is as opposed to having a sort of an aging population, which can be a drag and makes managing an economy quite hard work. So immigration is a theme. It certainly is opening up now, but it's due to be a positive contributor for the Australian economy for some time to come as well. Rhett, I think you might want to have discussed the current portfolio.
So hopefully what we've attempted to do is to give you a backdrop to how we see the future unfold. And as you know, if we don't know, we don't play. And so what we're doing is we're focusing our bets on a couple of underlying themes, but essentially they have to be very good companies that manage them. So first of all, we need quality. Second of all, we need pricing power. Third of all, we need a resilient and manageable cost base, low debt, and we also want good management. So we don't want a lot, but there are a couple of essential things there. And so what we try to do is show you the typical slide where everything in beige is what we consider defensive. And so they're not connected to the economic, they have very low economic sensitivities. The big chunk of 24% in financials, quite a few of them are also economically insensitive, but because the widgets they sell are related to money, we place them in the financials category. Consumer discretionary is surprisingly large, I guess, if you think we're worried about the consumer. Let me say that we're not optimistic about the consumer, but this is predominantly the best retailers. And I'm looking at that 10.7% in consumer discretionary. These are predominantly the best retailers in the country, have net positive cash balances. And even after our forecasts of quite sharp decline in earnings, we're still getting very, very low multiples of earnings, which translate into a higher after-tax cash earnings yield. I do want to stress that the after-tax cash earnings yield, that 7% you see in the middle of the page at the bottom, is what we think, 1 year out, that just through accretion of time, we can harvest. So that's 7%. And so if you think about us targeting a 10%, just over 10% return, through time, these companies generate at least 7% in incremental free cash flow after tax, with growth that pushes you above the 10% for the following year. They also have significant surplus balance sheets, which we expect that through this trying time, they will either use to buy additional earnings and therefore push up their valuations, or release that cash to us, in which case we get our hands on it. Our put position has been bouncing around a bit with the volatility in the market. It's currently about 7 or 8%, and our cash is roughly about 9%. So predominantly defensive portfolio. Can I now go, Mark, if you could go to the next slide where we break that down. So and this is what I said about getting into the weeds. We've given you what I think is the backdrop to how we see things. Now let's talk about how we apply them at a granular level. And so the first and biggest category in our portfolio has to be the combination of Medibank and NIB, which together make up just under 10% of the portfolio. Now, there's a couple of things to really like here. First of all, they absolutely will benefit from higher interest rates as the floats pay larger interest rates back to shareholders. Secondly, this big influx of immigration is impacting very positively, both through international students, foreign workers, but more importantly, also the bedrock, which is the residents' health insurance in Australia. The companies have managed COVID exceptionally well, and they've broken that nexus of over-servicing, which means as we come out the other side, there'll be a sharper reduction in the overclaiming and the excess servicing of patients by the medical fraternity. So we think it stands, in really good stead. The after-tax cash earnings yields of these companies are running at about 7 or 8% and look quite good. CSL and ResMed are probably a bit more problematic. At the moment, there is a very large negative reaction to anything to do with healthcare due to these GLP-1 drugs, which is supposed to solve all forms of obesity and make us all skinny and therefore have less medical issues. I'm not trying to make light of it. I do think it's a big stretch. We are finding that it's actually accelerating the usage because it's accelerating diagnosis for a lot of people with sleep apnea and diabetes. And so all evidence to date shows that earnings are actually accelerating rather than reducing. And we think ResMed and CSL have been overdone on this and are currently at very attractive prices. So in the interest of time, I'll take any questions on that later. But Mark, I might pass it back to you.
When we think about sort of buckets of our exposure, as Richard said, healthcare is a big bucket. Telstra is another of our major holdings. It's been a core holding in the portfolio for a couple of years now. And just to touch on maybe some of the reasons why we are there with Telstra. Telstra really addresses a lot of the themes, the thematics that we wanted, exposure to. In particular, we think one thing that is underappreciated when people consider Telstra is the fact that its main valuation or main earning streams that support its valuation have a good exposure to an elevated environment of CPI, of inflation. And what I mean by that is that if we consider Telstra's valuation, about 65% of its valuation is the mobile business, and about another 20 to 25% of its valuation is the recurring income stream that it gets from NBN, which is effectively from this point a 25-year rental agreement to use all of Telstra's ducts and pipes. And it's a 25-year agreement currently at about $1 billion a year, but importantly linked to CPI. And most analysts, since the beginning of that agreement a number of years ago, have effectively put 2 to 3% in their steppers for that into their models, and that, I guess, is your long-run CPI. But where we are at the moment, CPI levels up in the mid to high single digits, is a much larger step up or increase each year in a non-trivial amount of money that Telstra gets from what is ultimately a quasi-government body. So now the interesting thing is that those CPI increases are lagged. So some of the big increases for Telstra that we've seen in inflation over the last 12 or 18 months is yet to actually be processed through in those income streams. So it's a terrific exposure. It's a very steady, virtually certain income stream with some large step ups to come in the next couple of years. And that's almost a quarter of the valuation of Telstra. Going back to the mobile business that I referred to at the start, the 65% of the valuation, it's a very strong part of Telstra's business. They are the leader in mobiles in Australia. They have the most dominant network. And even though they are the highest price point, they do continue to grow their subscriber base because the consumer has shown that it is willing to pay for quality. The real transformational event for the industry has occurred over the last couple of years, and that is a refocus by all players in the industry on generating returns on invested capital. Effectively what has happened for the last number of years is a price war, largely instigated by Optus, but a price war where all the operators effectively discounted prices to try to gain market share. And if you have a look over the multi-year period that occurred, nobody gained or lost any share. The only thing that changed was the prices that they were offering and therefore profits. The industry essentially destroyed their own profit pool. They've all realized that now. Optus has stated return on invested capital returns well above what it is currently generating. And really the only way that it can get there is to increase prices itself. So you've got a much more rational mobile market, and Telstra is itself increasing prices by CPI each year. And that is driving profitability in that key part of the business. So we've got 85% or 90% almost of the valuation of Telstra having strong CPI tailwinds and in very good shape. Valuation remains very attractive. And if anybody's got any other specific questions, we'd be very happy to go into more detail on that as well. In the interest of time, and just so that we allow time for people's questions, I might go straight to Q&A. I'll flag that we can discuss our view on banks. The discretionary retail space is quite a counter-consensual position for the fund, one that has done well for us. Happy to take questions on that as well. But what we might do is just go straight to our Q&A now to allow just to make sure we've got enough time for people to ask us questions if you do have them.
Great, thanks, gentlemen. And hi, everyone. As Lana mentioned in the beginning, I am going to be facilitating the Q&A today. We have already received quite a few questions on quite a broad range of topics. So if it works, I'm going to try and group them together. But please keep the questions coming. If we don't get through all of the questions on the webinar, we will respond to you directly. First cab off the rank, and probably the key question is, in the current environment, higher for longer, slower growth, etc., how likely is it that you will be able to meet your stated objective of meeting the investor needs of a reasonable rate of return, which is around 10% at the moment?
So I might have a go at that. I did refer to it earlier. So the underlying thesis is that we have a collection of ever-growing annuity streams that currently throw off approximately 7 and a bit% in after-tax cash earnings yields. And that's the accretion in value through time. And so over a year, you could think that if share prices don't change, if nothing else changes, multiples don't change, there's no growth, you can receive approximately 7. So hopefully that's clear. The second bit is that most of the businesses are growing. In fact, all of them are growing. Maybe not the banks, but all of them are growing. And so as the growth increases, then these shares should be priced better for the following year, based on a larger after-tax cash earnings yield. And so I expect that we should get at least 3% capital growth, but the rest should be funded by earnings. We've built in a margin of safety in that we think it should be a bit more than that, but also given the surplus on everyone's balance sheets, and we've gone through them and I've added them up, and there's approximately on average 4 to 5% surplus on balance sheets that could either be released or used by additional earning streams, which would then give you additional capital growth. And so that's the framework within which we thought about it quite carefully. Now, obviously, you've got a headwind of the higher cost of money, which is doing the opposite of cap rate compression, expanding the multiples that are required. And that's why we're not in the high-priced, super high multiple areas, but we're in the very reasonably priced multiple area, and try to avoid those ridiculous multiples. So, Adam, hopefully that answers that question.
That does make sense. I'm going to try and combine the next two questions because I think that they sort of it will allow you to sort of address them both. So the first question is around the Chinese economy going through a particularly challenging period, and then another question is related to the fact that you have got 2 mining or resource stocks in your top 10. So maybe you'd like to comment on both. How exposed is the Australian economy, particularly the opportunities in the resources space?
All right, Mark. So I might start with that one, and hopefully in the interest of time, I'll cover it off. So there are 2 questions associated with that. The first one is and I'm increasingly cautious. I suppose cautious is a euphemism for petrified, but I'm extremely cautious about the outlook for the Chinese economy. There's always 100 reasons why it's going to go swimmingly well and 100 reasons why it's going to be swimming really badly. But the predominance of evidence does indicate that they have difficulties. Now, bear in mind that there's lots of evidence that you could draw parallels, or even worse parallels, to the lost decade of Japan. Similar things with demographics, debt, property valuations being absurd, et cetera, et cetera. And there's lots of evidence around that. Suffice to say that we're concerned about it and we're worried about it, and hence we do not have a meaningful bet of any kind in a China-facing way. So then why do we have 2 mining companies within our top 10? Well, first of all, let's just say Evolution Mining is a gold mining company, and we are very concerned about inflation and have been for some time, and that is quite a good hedge, given that we think it can generate an after-tax cash earnings yield commensurate with our requirements. And then, if the gold price does go up, all the better. But we're not relying on the gold price going up to make money out of that company. Secondly, BHP is 5% of the portfolio. We think that even if the iron ore price drops to its long-term average, we can still get a decent after-tax cash earnings yield. It is the lowest cost producer of iron ore globally. And as a result, we expect that it will be able to continue to produce iron ore and sell its iron ore, and therefore generate the cash flows. It does have copper and all kinds of other things for the decarbonisation, and those are nice to have, but the bulk of the earnings is iron ore. I should just focus on the fact that energy and resources make up over 30 to 35% of the index. I hate to say index in any presentation, but certainly we don't have a big bet there. But the bets we do have, of 5% and 4% in iron ore, and the lowest cost producer of iron ore and gold, make it a very carefully considered bet.
Mark, do you have anything to add there?
No, I think that's right. And I think, to Rhett's point, when we consider our margin for error, we consider an environment where that might cause iron ore to fall. And given there are a lot of major producers globally that would fall out of the system if the iron ore price reached a low enough level. BHP, the iron ore price would always settle at a level that is profitable for BHP, is essentially where we've come out. And that's what Rhett said. Its balance sheet is very strong. It could pay off its entire debt with about 2 quarters of cash flow. So it's in a very strong state. It has spent a lot of capex over recent years. It's simplifying its portfolio. So there is a lot to like about BHP, but it's just on Rhett's point at the end there. It's, for us, it's a non-trivial position, but for an index manager, we are incredibly underweight, and to the point of sleepless nights if we were. So we're always aware of that context as well.
Great, that does make sense. Another composite question coming up. The 65 and older group was the largest cohort on that chart showing population by age. That will obviously bring opportunities as well as headwinds. So maybe you can comment on that. And the second part of the question is that you mentioned that the inflow of immigrants is keeping the median age low. But how confident are you that this immigration is long-term structural and not a shorter-term normalization after the COVID disruption?
I think to start off with, we would acknowledge, and I guess the charts here would suggest that it is at an elevated level at the moment. We don't think it remains where it is right now. That chart tells you that a figure of about 200,000 to 400,000 a year has been the norm. It's sort of up around, sort of more 4 to 6 at the moment. So I think we do probably get a normalization of immigration, back to longer term trends. Australia is a very attractive destination for immigrants to come to for very many reasons. The quality of life, opportunities, etc. So as far as being an attractive destination for immigrants to come to, I think there's a lot of evidence and there's a lot of reason to think that will continue to be the case. And then it's up to the government of the day to manage the channel as they see fit. And I think, despite the high-profile nature of the illegal immigrant component of the discussion, I think most governments of both persuasions, see the virtue in a healthy growth of immigration, and it's very much been a part of our country for a long time now. So I'd be confident of a immigration trend continuing for some time. And sort of the various groups that forecast here, indicate that would be the case as well. In terms of an aging population, the cohort there, absolutely, it presents it. It's hard via the ASX to specifically isolate companies that sort of face mature age audiences, so to speak. You can get exposure at the other end of the curve to baby bunting and the like. I guess residential aged care is certainly one theme. Up until now, we've resisted the Australian aged care names, largely because we don't think that the combination of the corporates involved and the government have landed on the right model to enable sustainable economics for those operators in Australia. We know a lot of work is being done to enable that. We don't think they're there yet. We have been more active in the residential aged care in New Zealand. Overall, we think that they have a better model than Australia. It's not without its challenges at the moment, and we're working with some of the players there. But we think the New Zealand aged care model is, that's been one where we've played that theme a little bit more. But I guess, in terms of the overall exposure, the sort of population growth and the overall consumer spending, obviously companies like Woolworths, Endeavour could come into the consideration there. There's a number of ways to play a broader consumer. We more point to the fact that we just think that it's a component of the population which is helping, which is sort of largely not feeling the heat as much as what maybe some of the younger age cohorts were. So we'd really point to it by saying, don't assume that the whole country is being heavily impacted by interest rates at the moment.
Great, thank you. You touched on the weight loss drugs, and you mentioned ResMed and CSL. You've also got a lot of exposure to health insurers. Do you want to just give us your views on those?
Sure. Mark, I think I might take those. So first of all, just given the question before on health insurers, anecdotally, the private health insurance industry has added over 1 million new members in the last 2 years, both through greater participation domestically, but also a remarkable affinity by new immigrants, particularly skilled immigrants, to adopt private health insurance almost immediately. And so that's been very, very positive. So positive shift there. Obviously, the older you are, the more you use private health insurance. And so we've seen a lift even in the older demographics for private health insurance, in spite of a very punitive loading for people who come on late in their later years. So we think that's been quite defensive in that system, and that's a flight to safety, I guess. The really interesting thing about GLP-1s is that there is a mechanism of action that has interrupted the desire to continue eating by people, and as a result of that, it's resulting in quite large weight loss. The underlying mechanisms has some quite bad side effects, particularly muscle loss, nausea, and interrupting the dopamine flow. Also sort of creates psychological issues. So it's very expensive, this drug. It's been around for 8 years. It was discovered because it was designed as a remedy for diabetes. Even those who have quite serious diabetes have got a compliance rate after 2 to 3 years of less than 5%. So it's a very difficult drug to stay on. The hedge fund community has adopted this as the panacea for any healthcare system, and it's going to seriously, they believe it's going to seriously impact on the need for any kind of diabetic medical device or sleep apnea medical device. We have a very different view, but even if it does have a small impact, you would think that it'd be very, very positive for health insurance, because the claims would be lower. Now, we're not factoring that in. We think there's more than enough upside for health insurers, but I just want to try and give a balanced view. We always thought ResMed was quite expensive, and we held it because our average in price was below $10 and was trading at approximately $30. It's now come back quite a long way, and we think it offers a very attractive, for the first time in a long time, after tax cash earnings yield, and we actually bought a few more. Adam, unfortunately, I know way too much about this drug. I could go on and on about it forever, but I think I'll leave it there unless there are any other additional questions.
I think additional questions. Sorry. There's feedback.
Trying to get involved.
I think that an additional question is it too early to have any anecdotal evidence that these drugs have led to greater sleep apnea diagnosis or awareness?
So we had a detailed conversation where we're having them all the time, but the most pertinent to answer that question is something that happened this morning. We spoke to one of the bigger providers of sleep apnea machines, and I'll give you the following download. So first of all, 78% of their business is for resupply. So if you buy a sleep apnea machine, you get 2 to 3 masks every year in order to keep them fresh. And so the resupply business is a big part of their business. He was asked the outright question, as a result of any of your customers having GLP-1 and weight loss, what number have dropped off the use of sleep apnea? In other words, they don't need a mask supply anymore. And his unequivocal answer was 0, but it's still early, right? So you haven't seen any indication of that. The next question was, as a result of people being overweight, and therefore this massive publication of what weight loss drugs could do for your condition, are you seeing people actually being referred away from you to first do the weight loss rather than being referred for sleep apnea devices? And understanding the mechanism is really interesting. So the biggest challenge in globally is diagnosis of sleep apnea and getting people into the GP. And I'll just cut to the chase. His answer was they are seeing more and more referrals from the same referral base for medical devices for sleep apnea than ever before, because the pipeline has expanded, because more and more people are coming to see their GPs, going for a sleep test. So sleep testing is through the roof. And then even if they're being placed on the drug, they're being told to get sleep apnea medical device machine as well. If you're obese and you lose 20% of your body weight, you're still going to need, unfortunately, a medical device for sleep apnea. So hopefully I've encapsulated all of those questions.
I think that was very comprehensive. Before I wind up, any last messages that you would like to leave our listeners with?
So Mark, I might grab that one as well, if you don't mind. I really want to make a couple of points. So thank you for that, Adam. The first one is that there is a lot of volatility around, and there's a lot of hot money chasing stuff. The second one is, I do really want to stress that we always spoke about Tina. There was no alternative to equities. I know it's against my business, but there are a lot of alternatives to equities now, because the cost of money has gone up, and so you can get decent yields out of even just having a term deposit. And so that has to be at some stage reflected in valuations, and we are being patient and disciplined and very careful about the kind of companies we put our money into. And that's the message I want to leave with you.
Great, thank you. The consistency of your process really shines through whenever I listen to anybody from your team speak. But in the interest of time, I am now going to wind up. Thank you to everybody who submitted questions. The questions really do make the webinar, I think. We didn't get to all of them, so for those of you who didn't hear your question or a version of your question answered, we will respond to you directly. Thanks again for joining us, and enjoy the rest of your day.